Yo, what's good, guys? It's your boy Wolf back with another tutorial video. On this video, we're going to be talking about the Fibonacci. You'll see that in the title. And for the people who don't know what Fibonacci is, there's plenty of examples and plenty of videos on YouTube of what it is. But I'm going to go into my brief description on what it is and how to use it when trading. So, well, before I get into all that, I want to make an announcement on the Discord. I didn't realize that you basically have to pay for to be able to create and keep a link. So from now on until otherwise, I will be accepting anybody who wants to join the Discord. Just if you're interested, definitely just hit me up instead, and I'll send you a personal invitation link, and then we'll go from there. So yeah, let's just get into this. So the Fibonacci retracement. Well, what is a Fibonacci retracement? So I think according to Google, I'm just gonna skip past all the BS, but basically the Fibonacci is a sequence. It's a here, let me see if I can pull it up. The Fibonacci is a sequence. It's something mathematical. It is basically, you could see it everywhere in nature, whether it's like the way a flower grows, the way the galaxy expands, the ratios between your bones. It's a sequence of numbers. So basically it goes like let me read it verbatim. It says it's a series of numbers where each number is the sum of the two preceding ones, usually starting with 0 and 1. So for instance, like if you add 0 plus 1, that equals 1. Then 1 plus 1 equals 2. Then 2 plus 1 equals 3. 3 plus 2 equals 5. 5 plus 3 equals 8, and it just keeps on going like that. So yeah, that's just like what it is. I think there's even, let me see if there's an example. I think in your tools somewhere here, I think it shows your I don't even know where it's at. Hold on right quick. Yeah, Fibonacci. I think there's like, yeah, it's a spiral. It's something that looks like this, and that's what a visual representation of what that sequence is that I was just talking about. It's just a mathematical sequence, whatever. Anyways, hold on real quick, forget my timer. All right, cool. So that's just what it is. That's what Fibonacci is. So when you hear that Fibonacci, that's just what it is. Now, what is it in relation to trading? Okay, so the Fibonacci is just a retracement. We can head back to market structure. On the last video, we were talking about the last tutorial video. We were talking about how price can tend to go to and from support and resistance area, zones, etc. Right? I explained how I do and how I prefer to trade these, or really just look out for these, or really acknowledge the fact of when these start to come into play, when just basically price is moving sideways. But when price is about to break out of a let's just say it breaks out, now we're starting to trend, and this is where we want to take trades. Now, alongside with support and resistance as being a key factor to that's going to play into finding key levels to then take trades off of, the retracement, the Fibonacci retracement, is an area. Let me just point this out right here. It just a general idea is a place where price pulled back. It's just a place, a specific, and we'll get into the details. A place where price pulled back and is a key area, just like support and resistance, where price continually keeps hitting back and forth. Except in this, it's just a consistent, typically consistent area where price likes to turn around and continue the trend. Right? And I'll show you some examples in this, but that's all it is. Fancy word for that. So, okay, so on here, on TradingView, you have a tool for this. Oops, not this one, I'm sorry. You have a tool for this. So let me see. Let me go back to the original, apply defaults. Okay. So in TradingView, you have the Fibonacci retracement to your left. The Fibonacci, let's just say, in fact, let me draw this up real quick. Just draw a general place right here. so we can see what the tool is, how to use it, and yeah, just to get a visual on what it is. So with Fibonacci, you're going to click on this and you're going to start from the bottom or top of a swing high or low. So in this case, there's a swing low right here, and then there's a swing high, which is right here. All right. Wow, I was close right here. Okay, so on this tool, right, and this is how you once price breaks out of a trending, once price breaks out of a ranging market and starts to trend, you could utilize the Fibonacci retracement to then take entries. I'm talking about Fibonacci's because I actually use this kind of not necessarily different, but it's just the idea of basic retracements. Areas are key areas where you will want to enter, and like I said, this is important because this is how I utilize Fibonacci retracements to make trades. So on this, by default, you have the point, swing low, in this case, a swing low from where you're going to start, and the end of that swing before price started to trail downwards. So the Fibonacci retracement is the golden ratio, of the percentage is 61. It's actually 61.8. But this is just essentially telling you from the point of the bottom to the top, price retraced 61.8%. That is what the Fibonacci is specifically. Now, price doesn't always have to come down. Let me draw this out. In fact, let me do this. I need to change the settings because everything else is going to get confusing. We don't need a couple of these actually. We don't really need. Yeah, let's not confuse ourselves so we can focus. 50%. Okay, cool. So this area right here, 618, is the distance between when price shot up here, price retraced 61.8% before it started to go back up. This is all you really need to know if you're just trading Fibonacci. This area, let's just say I just drew this out. I draw this as my golden zone. Let's just say, right? Fib. Let's just say this is my area. It's not a specific like point, but sometimes it could just tap right into it and then continue to go up. It could tap into it and go through it, and it go up from there. But typically, you know, like I said, I'm gonna show you examples of this happening in real time. It happens everywhere, on every time frame, with every instrument. It doesn't even matter. But this is important. So again, the Fibonacci retracement is the area or zone or percentage wise of to which price retraced back into and then made a reversal to continue the trend, right? So when price comes down here, you want to see some type of reaction. That will kind of be an indicator for you to get in, but that all depends on what is printed and etc. So now that we understand this, okay, price does not always have to come down to this price. I'm sorry, this percentage. So this 61.8, 50%. Price could come 50%, come down 50%, and then continue. Price can come down 38. Just some other numbers that I really don't pay attention to that much. It doesn't really matter. Price can come down 70%. Price can come all the way down to 100%, which is basically where the swing low is, or at least originally. This is when I would consider this area equal lows, aka support. But if price comes over here, you have to be more so. This typically happens when the price is really trending. So price went up, came back down. Generally, it is 61.8 Fibonacci area to continue up. All right, cool. We understand this. So I'm gonna bring out, for me, I have default just to focus once again. Remember this area right here. It's going to be represented as this gold line right here. So let's go to the charts. Okay, on the NAS 100, on a 5-minute time frame, we're following market structure. Okay, so I want to explain. We're going to use from, let's just say, just so we understand where we're at. From this I would say this moment, from this moment on, yeah, because right here is pretty much just choppy. So we're going to utilize this low and this high right here and back right here as far as like we're going to consider this basically a range because price made a low and it made a high. So this is kind of, we're going to start from here. So just so we could focus, and then we'll just, I don't know, just follow and see what happens. So in this example, once price, let's talk about the market structure over here. So over here is a support and resistance. We went over that, relatively equal highs and lows. Okay. Now when price broke structure and it broke right here, okay, price continued to go down from the highest point. This is when you bring out your tool, the Fibonacci tool. From the highest point, the swing high, price came down, broke structure right here, kept going higher, lower highs, lower lows, lower highs, etc. to this point right here. Okay, zoom in right quick. From the swing high to the swing low. Once price decided to start making its way back up and do a little pullback, it stopped right here at the Fibonacci sequence and then continued. Okay, let's see how many we can spot. From this swing high now, all the way down because it broke structure to right here. Broke structure right here. From this high to this swing low, price broke structure, and once it started to retrace and pull back, it came back to the 61.8, the Fibonacci zone right here, and then continued to go down. Now, for instance, if you were to take a trade, let's just say if you had an order, you put your stops above that swing high, and then you could target back down to the low. And this is the first trade. Let me delete this right quick. So let's say, for instance, this is what happened, right? Price came down. When price pulled back, this is your entry to go down, and then boom, this is a 1 to 1.58, 1 to 1.6, right? Cool. That would have won. Let me bring this example. Same thing. Price came down. The Fibonacci right here, your entry would have been right here on this candle. And the same thing. Short. Got in. Put your stops above. Aim back towards that swing low. That was a 1.6. So you see the consistency right here. Now, this broke structure. This is not a perfect strategy. I should have mentioned in the beginning. You're gonna win. You're gonna win some. You're gonna lose some. This was a loss right here. Price came down. Price came up, and then it just shot straight through. You would have lost this. You would have won 2, lost 1 if you were to continue to trade. I don't recommend trading so much. You only need to get 1 of these setups a day to actually be profitable, to be honest. You just need to be able to catch it once it really starts. That's why I wanted to start right here, because price was going up, trailed sideways, and then it broke with a lot of momentum, and that was a perfect trade for it to come back up and then shoot down. That would have been it. If you was a risk to take that second trade, because price shot down with momentum, also support came up, retraced back to that the golden zone, and then shot back down. 2 trades right there. You would have made let's just say that's wasted 1 to 3. No, like 1 to 1.5 twice. Anyways. Okay, so that's an example. Let's see what else. Okay, price shot up. You lost on this one, but look, it made a high. It made a high. It didn't break this high right here. But price came from up here all the way down here, breaking structure. We're gonna do it again. The swing high all the way down to this lowest point, which is right here. Now, price is right here. Price came up to this area. Put your stops above. Let me bring this over. So you would have got tagged in right here. Tagged in right here. You were sitting in some drawdown right here. Price next candle shot back down and continued, and you would have won that as well. Right? So 3 trades right here. 3 winning trades right here. And 1 losing trade. That's profitable. This is a very, very simple strategy, but this is how you use it. You don't have to use the 61.8 zone, but that is just a typical thing that you see over and over again. Now, I want to go into a little more detail and show you an example. Now, this is on a 5-minute time frame. Okay, market structure is true, and it just tends to happen all the time. So let's just say, for instance, now I could take a candle. Let me see. Let me just take this candle. I'm gonna put this candle. This is the candle that broke structure right here, and it's the same thing from the top to the bottom. Let me bring it out, and we're gonna go down to the 1 minute time frame. On one single candle alone, you're gonna see this again. You're going to see this again over and over again on one 5 minute candle alone. If it's following market structure, it's going to do the same thing. Price shoots down, picks a direction, start the trend, and it has to retrace. Once it retraced, look what it did. Price came back up to that Fibonacci zone. You would have got in right here. Put your stops above. Target the low, the swing low, and once again, boom. So detailed or not, it happens over and over and over again. Let's see that we can find another example. On a 5 minute, and this is crucial because this is what I'm trading. This is how I trade. I'll trade a single candle, understanding that on a small time frame, it's just a Fibonacci retracement. Very, very important. Let's see if this works out right here. Big candle. Okay, we could tell that didn't even work out, but we're gonna go into details and see. This did retrace to the 50 level. This little gray area right here is just price retrace 50% to then continue to go down. But let's go into detail. So breaker structure, major candle. Let's see what happens. Let's go in a 1 minute time frame real quick. Yeah, that was real close. So what happened? Price swing high of that same candle. These are 5 minute candles right here. Oh, I'm sorry. It was a 5 minute candle, each being one candle, 1 minute candles. Within that single 5 minute candle, price came down, shot up, and it did hit the 50% to then continue downward. So that one didn't hit. We just don't worry about it. Sit on our hands and look for another opportunity. Let's see how many times this does play out. Fibonacci is just a key. It's a key place. This one was a loser. We already knew that one. Right here, breaker. We can see the breaker structure right here. We see the consolidation, and then price decided to make its move. Breaker structure right here. Boom, down this candle on a single candle. Fibonacci high to the low, which is right here. High, low. Let's go down to the 1 minute time frame and see what that looks like. All right, boom. So the high down to the low, and your entry is right here. It's the same thing. Fibonacci is everywhere. Whether you choose to specifically do it exactly how I'm doing it, which is the very, very basic, where you could literally set a order and just walk away. If it wins, it wins. If it doesn't, it doesn't. If it comes 50% and misses your 61.8 area, then it is what it is. But as you can see, this was a winner as well. High broke structure right here, because if you're on a 1 minute time frame, this is what you'll see. Price broke down, came up, retraced a bit, came back down. All right, this is important on a trending market. Okay, whether it's bullish or bearish, you could do this buying or selling. Don't try to do this when we are in ranging. Once again, we're only doing this when it's going up or down. Okay, not no ranging. We don't need this because it's just going to hit your stop loss every single time. It's going to wick you out, and you're going to be upset, think the strategy isn't working, or Fibonacci doesn't work. Fibonacci to me is just a word that's just representing where price is going to come back to, or just like you can use different percentages. Even if you wanted to use 50% in all of these scenarios, it did come back at least 50%. And that's another key thing. You need to let price come back at least 50%, or the trade just wouldn't make any sense. If price is like under, like we're not trying to chase trades. If the structure is in a very bullish or bearish market, and it's a very strong pressure, like price, it may not retrace all the way back up where you will want to. You'll miss some entries if you're just specifically trying to go for 61 or 70 or etc. Because you can customize these retracement zones to your liking. It just Fibonacci tends to be a very, I ain't gonna say like a safe place, but it's just like it's a very common place. So yeah, so the last thing with the Fibonacci retracement, now this is going to be a little bit more, let's just say, aggressive. As you can see with each one of these scenarios, you start to see a common number. which is basically your risk to reward is you're risking 1 to make 1.5 or 1.6. Those are the common numbers. Now, how can you tweak that a little more? Let's just say, for instance, let's take this first one as an example, right? Let's just say I wanted to trade this candle. It broke structure. I can see this visually closed. Price shot all the way down here, which means it broke structure on a bigger time frame. On a small time frame, we know that, and it closed bearish. If I went to the 1 minute time frame on the same setup, right, we're risking 1 to make 1.5. You could change your risk reward based off of where you set your loss. I'm sorry, your stop loss. So in this case, if you're on a 1 minute time frame while you're watching all this play out, on this candle right here, on this candle, the one that tagged you in, right, or what tagged you in, or in this particular case, if you was to get in manually, if you want to change your risk to reward, and this is going to require back testing and getting used to the pair that you trade, because you got to see this over and over again. Price shot up, price on the next candle shot down. Now it's either you can risk, if you're a swing trader, intraday trader, depending on what time frame, you can just simply let it go past this swing low or your target price, take some profits off, but of course you will want to let it run if that's if you're cool with that. But your price comes back down, you will want to get in, but you put your stop loss above the candle. So in this case, price came down, broke structure, retraced back to the at least 50, but in this particular case the Fibonacci zone, which is 61.8. Price came up, next candle started, came up a little bit, it didn't make no higher highs, it didn't, etc., and it came down. Once it broke this structure right here, that's when you get in. Now once you get in manually, your stop loss is going to be basically above this candle, the same candle you got in, and you're going to ride this down again to this swing low. This significantly changes your risk reward. Now it's a 1 to 2.4. Okay, so this matters. This is all you need in one day. Whether you want to play it safe, conservative, which is putting your stops above the whole swing, or if you put your stop below the candle itself, you need to go down to a lower time frame to see the details to make a decision. Like I said, you would have got in manually right here, not just set an order and then walk away. And of course, you need to manage your position. By the time you get like a 1-to-1, you could have took some profits off the table, and then just let it ride. Bring your stops to break even, and then you just watch what happens. So yeah, this is just the basic of the Fibonacci retracement. And yeah, I utilize this. This is very important. If you wanted to learn from me, you got to know what Fibonacci is, or I keep saying Fibonacci, but you need to understand retracements. You need to understand that if market is trending, that your way of getting in is that you have to wait on the pullback. How far does it pull back? We don't know, but it's typically 61.8, which is the Fibonacci zone. So yeah, that's all I got for this video. It's been a long, drawn out video, but got to get the basics. I'll probably more than likely be making a part 2 or 3 on Fibonacci, because there's different ways to get on it. But yeah, y'all let me know down in the comments what you guys think about this Fibonacci, and if you guys want to see anything else, definitely let me know. If you're interested in the Discord, hit me up so I can send you an updated link. And yeah, that's all I got for this video. I appreciate the love. Like, subscribe, and yeah, I'll catch you guys in the next one. Peace.